On Monday, one of the long Treasury bonds went below 50 cents on the dollar. And that's the second time in a week that that's happened. And that's the first time historically that I know of that that's happened. A US government treasury, that is, the treasuries are the foundation of the global market. And what does that indicate? When something drops that much, it was from 98 cents when they sold them to 50 cents-ish below today, that's telling you that nobody believes or investors don't think that you're going to have the ability to repay this debt, at least potentially. That's the US government that can simply do this to pay their debts.
On Monday, the price of a US Treasury bond due in May 2050 dropped below 50 cents, a most concerning event considering that the Treasury initially sold $22 billion worth of the 2050 securities at about 98 cents. Such a steep drop in bond prices, 50 cents on the dollar, is probably one of the first signs that investors are gradually losing confidence in the US government. It signals that investors believe the seller of the debt, in this case, the US government, is in financial distress that could lead to a default. Plus, this is not an isolated incident. The security had initially dropped below 50 cents about 2 months ago. The price drop does not mean the United States is in any danger of defaulting on its debt obligation, at least not in the short term. US Treasuries are still considered the safest government debt in the world. But it does illustrate the scope of pain inflicted on investors who purchased these securities at record low interest rates in 2020. Less than 2 years after these fated purchases, the Federal Reserve started tightening at a very aggressive and record-setting pace. The bond in question has taken a huge hit, considering that its interest rate, 1.25%, is the lowest ever on a 30-year Treasury. A similar 30-year debt issued just last month had a far more attractive interest rate of over 4%. Other long-term Treasuries, 10 years and above, have slumped by 4% in 2023, after a 29% record decline in 2022. That's more than double the rate of decline in the broader Treasury market, according to data from Bloomberg. According to renowned precious metals investor and market analyst Lynette Zang, all of these are signs of what's coming for the U.S. economy. Lynette believes we are battling the consequences of the global collapse of 2008 and the reckless reaction of central banks to the crisis. According to the ITM Trading chief market analyst, they sealed our fate when they started printing uncontrollably during the crisis. As a result, inflation was baked into the system, and every move they've made since is just to delay the inevitable. We will now bring you clips from Lynette Zang's recent interview with John Williams. She discusses the U.S. bond market, inflation, and why it is absolutely important you prepare for the inevitable by buying and holding gold and silver. Please take a little time to give the video a thumbs up, subscribe to the channel, and turn on post notifications for more videos on precious metals and other commodities. Also, ensure you drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
I think the world got real crazy in 2008, 2007, 2008, which is when the system really died. Okay. I've studied currencies and currency life cycles since 1987. And what you see when you look at that are repeatable patterns that have happened over 4,800 times, 100% of the time. And so when you see that, it gives you an indication of where we are in the cycle and how many things that they're saying, wow, this has never happened before, or this last time this happened was in 2007, 2008. Or 1913 or 1933 or 1960s or 1970s or 80s. What they're missing, and I've only seen one article actually expound on that, is what was happening during all those periods of times where that we were shifting from one monetary system into a new monetary system. And if you don't know that, how can you properly get prepared? Interestingly enough, even though they don't know how in the world the inflation started, I mean, I can't imagine anybody knowing how inflation starts. They were fighting inflation by rapidly raising rates. Now, here's the thing. Since 2009, when interest rates were anchored at zero and we went into this massive free money promotion to make it appear like we were getting growth, because you can do that with debt. You can make things seem like you're doing well, seem like you're growing, seem like you're affluent, but at some point that debt gets repaid. And now we've got, whether it's governments, corporations, or individuals, we have walls of debt that are coming due, that typically the whole monetary system is based on constantly rolling over that debt. And they're rolling it over into interest rates that are what, 700 times what they were paying, right? The opportunity to restructure their higher interest rate debt into lower interest rates was there. But then what they did was they kept going and they kept building more debt. And I don't care whether this is really mostly true in the corporate world, because governments just keep building debt. But of course, their job is to keep you calm and keep you in the markets. And, there's so much work that's even done off balance sheets that we can't even really see. I mean, how can you make an educated decision on anything right now? You can't. On Monday, one of the long Treasury bonds went below 50 cents on the dollar. And that's the second time in a week that that's happened. And that's the first time historically that I know of that that's happened. A US government treasury, that is, the treasuries are the foundation of the global market. And what does that indicate? When something drops that much, it was from 98 cents when they sold them to 50 cents-ish below today, that's telling you that nobody believes, or investors don't think that you're going to have the ability to repay this debt, at least potentially. That's the US government that can simply do this to pay their debts. That's not good, because that's about confidence. And this is a con game, and it requires confidence.
According to Lynette, the U.S. government has so far kicked the can down the road, but this seems to be the end of a very long road. At the very least, the renowned analyst expects another, more destructive U.S. banking crisis, which will wipe out more regional banks, further strengthen the too big to fail banks, and cause a severe liquidity crisis that will ripple through the economy. Lynette believes inflation and the Fed's aggressive rate hikes are both carefully planned events designed to make the poor poorer and the rich richer and lead us to the final endgame, the introduction and enforcement of central bank digital currencies, CBDCs. Here are more clips from the discussion.
I think it's going to segue into a huge, huge banking crisis, liquidity crisis, which we've been working on for a long time now. And then that's going to justify bringing out the CBDCs. I don't think that we really know how far along all of the central bankers are, including the Federal Reserve, to issuing the CBDCs, but the Fed Now accounts went into place in July. And they announced those puppies back in 2019. And during March of 2020, weren't they saying how much easier it would be to get the money to the public so that they could, because they're being good to the public, really, so that they could spend this money and continue to support the economy? How much easier it would be if they could just push a button and boop.
They're just trying to combat inequality, Lynette. Yeah, right.
I mean, it's obvious to me what is really happening in here and where we are headed. The question is, and this is the issue that some of the countries that have been experimenting with CBDCs have had. Yes, when they give them for free, the people will use them, but they don't reload those accounts.
Right.
So we have a chance. Yes, they're going to use this crisis to introduce it, and if you are completely dependent on this garbage, what choice are you going to have, right? You're going to have to go along with what they want. But if you have physical gold and physical silver in your possession and they try to get you to reload it, you go, nope, I'm retaining my choices. I'm retaining my purchasing power, and I'm retaining my freedom.
If you don't hold it, you don't own it.
Yep, that's my motto.
Yeah,
and it really is. And that's even the Bank for International Settlements motto. They state gold is the only financial asset that runs no counterparty risk. Everything else is credit. It's all a contract. It's all counterparty risk. Not this. You hold it, you own it. This is going to protect you. And so will this, but physical in your possession. I think the next step is going to be a bigger crisis, because what happened in the banks, it's not over. And that wall of debt that needs to be restructured or reset into a new contract. You know, I think we have a crisis. I don't think we go backwards. I think we go forward, and that crisis will scare the crap out of people. And the Federal Reserve will have now controlled the wage price spiral of inflation. But, you know, I mean, it's a joke to say that they conquered inflation, or that what we're seeing in terms of their numbers are even really accurate in terms of inflation. So I think inflation is going to rear its ugly head again, particularly at the gas pumps. When they set up this system, they basically wanted to accomplish two things. For governments, they wanted to be able to tax you without having to go through legislation so you knew where you were being taxed. For corporations, they wanted to pay you less, but they knew if you were used to getting $10, you wouldn't accept $5. However, if that $10 spent like $5 and all that extra went to them, well, there you go, income and wealth inequality. So we're just at the end of this currency's life cycle, and what they want to transition us into has even more control over us than before, because they definitely don't want us to own any equity. They don't want us to hold any assets. They want to take us back to feudal times, where there were just a few people that owned everything and everybody else is leasing everything.
On September 18th, the debt of the United States government hit $33 trillion for the first time in history. The total debt divided among taxpayers equaled $252,000 per taxpayer. In the past 6 days since then, the debt has grown by another $104 billion, and it continues to climb. Debt per taxpayer now equals $255,353 per taxpayer. In addition, as the debt gets more massive, so does the debt expense, which currently sits at $706 billion, just $88 billion lower than the defense budget. In 2024, the Treasury Department is expected to issue more debt to cover $7.6 trillion in maturing debt securities and a $2 trillion budget deficit, a $9.6 trillion reason for inflation to spike sharply again and probably become sticky for a few more years. Going by the current playbook, the Federal Reserve will probably insist on holding interest rates high to combat inflation, while the rest of the economy goes up in flames. What are your thoughts on Lynette Zang's outlook on the U.S. economy and her insistence that gold and silver are the only true safe haven assets that will help weather the storm? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos on gold, silver, and other commodities. Thanks for watching.